Hello, how are you today? Can you see me?
No, but I
No?
see next to the logo, I see it says create a channel to join the chat. So maybe I need a channel. Is that possible?
No talking. So let's see. Can you see my screen?
Mhm.
No. Okay. Well, other people are obviously in on the link as well. I can see them, but I can't see you. Okay, so let's see. Nothing's working. Hello, everyone. Can you hear me? I'm about to get through my technical problems and straight into a screen. So, oh, good, Paul. Hello. Yeah, I can see you, mate. Nice, Mark. And well, nice to see that a couple of you got here. Okay, so the first thing we're going to do is we're going to look at the markets. And can you see me, Sabina? Excellent. Can you hear me okay? Fantastic. Okay, so the first thing that you need to do before you start trading is you need to understand where you are. Imagine you are floating in space. You don't know which way is up, which way is down. So as a trader, you have to understand where you are because that's how you learn to trade. So the first thing we have to do on any market is we have to work out direction. And a market like this, which is the DAX, but it doesn't matter which market I trade, could be any market, but we can look at the DAX as one market. I'm just going to go to comments just to see if any of you want me to cover another market because I don't care which market I want to cover. So is that everyone okay with the DAX? If you could leave a comment. Okay, Mark, yeah, excellent. Anyone else? Or do you have a preferred market? Would you like me to do gold? I don't mind what I do. Let me just push this to one side. Okay, so Mark said, yeah, he doesn't care. Excellent, Mark. What about anyone else? Paul? Yeah, okay, DAX. Right, so we're going to get into this DAX chart. So all good analysis starts on the weekly chart. You want to know where you're going. So you can see that we've got this huge blow off move in the DAX now. When you see a powerful move in effect, after a long run up, you've got to be careful because things like that is where the market makers are enticing people to buy. We've got this top, which was taken out. Let me pull that one across just to here. Now, I know a lot of you have got the indicators. So if I was just to put the histogram chart on this and have a look, just to see what's going on. So I'm just going to insert, in fact, I'm going to go to the template, which I've got, which is called Load Template Super Trader. And we're just going to have a look. So what we've got is we've got the map on, we've got the histogram on. So the question that I would ask myself here on the weekly chart, are we looking at potentially a level where you could actually see a change in trend? So if you look at that low there, you see it's got that level of histogram. So I'm simply mark that like that. And then we just bring this line across and we just mark that level there. So I'm just going to pull that one up a little bit. And then we could go to this level here. So this is a weekly chart and we're looking at the high histogram levels. You can see we've got the histogram has just moved up into that area yet. You can see that at its low, there was a massive histogram. But what have we got at the moment? Well, we've got a histogram which is coming up into a level where we've had previous turns in the market. So at this level, you certainly wouldn't want to be going long. In fact, you should be thinking of a reversal. Now I just mark that. So, okay. Right, so this means that we've got to be cautious up at this level because we've got that high histogram reading. Let me get that really big so you guys can see it. So quite clearly, this is a level that you shouldn't be going long at because you're getting massive liquidity. And I don't think that the market makers are actually buying up there. That's the people who are basically on the wrong side of the market, fear of missing out. And that's it. So we know that on the weekly, the DAX is looking weak. So what I would do now is I go down to the daily chart. And the important thing that you should do when you're trading any market is you should mark the high and low of yesterday's candle. Why? Well, if you mark the high and low of yesterday's candle, just like you get the orientation as a spaceman in space, you know which way is up and which way is down. So what you would do is you would mark yesterday's candle like that. And because I trade the S&P quite exclusively, I would say to you that whatever market you trade, you have to look at the time frame and the market because they're all slightly different. They all behave slightly differently. Like I know the DAX moves in the European session, and I know that the S&P moves in the American session, and it makes a lot of sense. So you're likely to get the powerful moves in the S&P, and we go to the S&P in a bit, but that's what you would have done yesterday, or not yesterday, the day before yesterday. And so if we go down now to a 4-hour chart or even an hourly chart, you can see that we didn't even come close to the day before's low, and we didn't even come close to the high of the day before. So for me, technically that market hasn't broken down, but as soon as you do start to break down, what you'll see is you'll see that the highs of the previous day will actually be traded into. So you'll get price action starting to develop in there. And then what will happen is it will start to play off that level there because it was the previous day's high. As traders are getting stopped out, what they will do is they will start to exit their positions because they're worried. So people who were buying in at this point here, and of course, if you were buying in at that point there, you would be worried because you've got massive liquidity coming in there. So you certainly wouldn't want to buy. In fact, at this point, I'd be very cautious about trading this market at all. So questions, because I need a little bit of feedback from you guys. Everyone understand this so far? Anyone? Okay, good. So what I would want to do now is I want to go down to the S&P because we can talk about that one because I'm very familiar with trading the S&P. So I was trading with a little bit with Paul yesterday. So I'm just going to change that template and we're going to put it on clean black and white. I'll just explain a couple of things. So always go on to the H4. And if you watch the first video of how to trade, etc., what we really want before we want to go short this market is just like we had before. You want to move down, you want to move back up, that then doesn't take out the high. So compare that to where we are now. Let's say I'm right and the 17th, 18th is a turn. So I'd put that there. I was thinking it could be the 7th, but it wasn't the 7th. But we did have a little bit of a down day on the 7th. So that's when I got excited. But you don't get excited because you shouldn't really try to catch that first move. And if we look here on the left-hand side, you can see that as soon as that market broke, that little swing low there, I'll color that bar differently so you can see it. Just put that like that. You can see as soon as it broke that level, that meant that the top was in. And, you know, at this point here, you've got your head and shoulders pattern, which, funnily enough, when you do get good turns, you do get your head and shoulders pattern form just like that. So the first move is never the one to be on because it's usually the one that's retraced. Sometimes in crashes, it moves very hard, but most of the time, the second move, let me just put narrow, what I mean by the second move, is that one there. That's the one you really want to catch. So if we apply now this logic to this market on the left hand side, we would have to break that low there. And in order for you and I to get really excited and say, is this cycle in? It could be, but you're never quite sure with a cycle. Could be 2 days adrift, 3 days adrift. So the first move that we would want to see is we want to see a breakdown below that low. And if you didn't catch any of that, although it would be about a 900-point move, it doesn't matter because it will bounce all the way back up. Now, the other thing that you should be looking at, and I'll show you on this chart here, is you should be looking, once you get a market declining, you'll notice, if I put this in, you've got voids. So here we have a liquidity void, and you see that it came back and it just tipped the top of that liquidity void. Voids are very good, especially on first moves, and I know that Demonfire has done quite a lot of excellent analysis looking at how these markets break down. If you are trying to sell a market as it comes up, as I used to in the old days, and I think a lot of us are guilty of that, what will happen is the market will come up, you'll get stopped out, stopped out, stopped out. But if you wait for this first move down and you wait for the break of the previous swing, you can get in with some really laser-like entries. So if we look across here, we can see that on the H4 chart, we have no void formation. So the formation of voids also give you a clue. Are the big boys getting out? Because if they're getting out of a trade, they take big positions and they cannot help but push the market down because they've got such large positions that they've got to exit. So we haven't even got the formation of a void there. And if you've got the void indicator, you can throw it on. I mean, I can see those by eye, and a lot of you will see them by eye. I mean, you can see that this is also another void. If I was looking for voids, I draw this one here. And thanks to Anne for teaching me about voids. So do you want me to explain voids, or are you all pretty familiar with what a void looks like? Anyone? Okay, Mark, excellent. You're both both excellent. You're the only two guys here. I love it. Only two asking questions. So we now know that if you're forecasting a cycle, and you really don't need to forecast a market, what you need to do is look for movements, certain triggers. Now, because markets are fractal, you can apply this same analysis to any time frame. And in fact, I know, Paul, yesterday when we were talking about the S&P, and I put in the Discord channel that I was expecting it to come down and retest the bottom of the Asian session low and then maybe bounce to the upside. So I'm going to explain why I thought that. So we go into the hour chart, and I'm going to put on properties, show period separators. So Very important when you're trading a market like the S&P, you have to mark the Asian session high and low, because usually the Americans will trade back into the Asian session. So if I mark that and I go for the first couple of bars, about 8, something like that. So that's your Asian session. So if we just copy that block and we just put it here like this, you can see that virtually every time the Asian session has been tested. Sometimes they don't do it on the same day. So if you look here, that was the Asian session low. They didn't take it that same day. They took it the next day. So first they took out the high, stressed traders out, stressed them out. Yeah, I'm pretty stressed out. And then you can see they just blipped that top, and then well, first of all, they took low, cleaned up here, and then they took the top. So this is a nice strategy. And I said to Paul yesterday, I said, they will probably come down, test the Asian low, and then we will probably go up. And that's exactly what they did. Although that isn't drawn massively brilliantly, that's perfect there. You'll see that that's the Asian session. And they just played around the Asian session. So Asian session, extremely important for the S&P. You'll probably find gold has something similar, although I can't say that's definite because I don't trade gold a lot. So the retest of the Asian session. Now, I guess you guys want to know, how would we enter a trade? Would you like to know that? Let's see what the gang is saying. Okay, Paul. Right, excellent stuff. So with this one, I'm going to put on the template. So let's say the template, load template. So we're going to put on SuperTrader, and I'm going to put on period separators, because period separators keep you rooted in the moment. So really important, what you have to do is you have to mark yesterday's low. Let's say we were trading Friday and we want to know which way we should be trading. So we've got yesterday's low and we've got yesterday's high. So when you're trading at or around yesterday's high, you should be looking to go long, basically. So once we were there, we should have been looking to go long. But if we go down to the 15-minute chart here, I mean, I can put the Asian session range in as well. I'll just do that. So just about 8 bars, something like that. So something like that. Now, we know that the US boys love to take out the Asian session high and low. So I suppose we would have been something like that. So when we started that day, we would know that they're going to hit the low, they're going to hit the high. So as we're trading above yesterday's high, at that point there, you would have known that your bias should have been to the upside. We're nowhere near yesterday's low. So if I go down onto a 15-minute, and you could take these trades if you wanted. So that's your Asian session, very important to mark that. That's yesterday's high. So you can see as we pushed up, we get the aqua candle formation here and here, and then we get a blue candle formation. We also get really high liquidity up at that point. So you know something is amiss. Now, usually what I will do is I'll drop down onto a 5-minute chart. Once I see aqua candles on a 15-minute chart or a 30-minute chart. So if we put a line here, because that would have been the first time that you saw a 15-minute aqua candle. So now we go down to the 5-minute. Why would I have looked to sell? Well, yesterday I was thinking to myself, it's Friday, the market's pretty much stretched after that move up. We haven't taken out the Asian session. We know that they love to take out the Asian session. So at this point up here, we have a high probability that the Americans are going to send this market back down and just take out the Asian session. So as we pushed up here, I was thinking to myself, maybe. And unfortunately, on this day, I was looking for the same thing to happen, but it didn't happen. Sometimes it doesn't work, and that's just that. But if we had watched for the first Aqua 15-minute bar, we'd gone down onto the 5-minute chart, we could see we had Aqua Blue here. So that would have been also an area I would have looked at. I would have marked the top of the blue candle there. Just get that one right. Let's just cancel that, just move that one up. So I think you, Mark, are very good at doing this sort of thing, but I would have marked the top of the blue bar there, and that would have been my entry. Let's get that nice and big. So why would I have entered there? Well, I didn't see an Aqua candle on the 15 minutes, so that really wouldn't have been an entry for me. But this is the technique, always the same. So here we got the 15-minute bar forming the Aqua candle on the 15-minute time frame, and at that point I would have been looking for a trade, because let's get that on the 5-minute time frame. Yeah, so on this time frame, on this point, because I've got higher time frame liquidity, I've got a better opportunity to take a trade. So this trade here had no higher time frame liquidity, so that's kind of a dubious trade. Also, if you look, the time there was 12:35. 12:35 is not the American session. The volatility in the American session comes in around the open. So the open is a good time to trade the US session. So if we look really closely in here, you can see that you had your Aqua candle, you had your blue candle. Now, I don't trade on Aqua candles, so all the way that this market moved up here, I'm not interested. Why? I'm not interested because I didn't see a reversal. I want to see the market makers actually showing their hand. Now, once you've got that blue candle there, there's your entry. So it's a laser-like entry, and you know, because the way these algorithms work, that the minimum target that you should have gone for there is the bottom of the Asian session range, which is about 229 points. Now, late in the evening, what was I doing? I was messing around. Me and Paul were chatting, and we're having a bit of a laugh. And I said to him, you know, at the end of the day, if they are at the Asian session low, I'm looking to go long, even though it was Friday. So even though it was Friday, I was thinking to myself, they might send this market up. So let me show you a very nice structure that I was looking at on Friday night. So as we came down, you had this little shoulder, you had this little neck up here. We then pushed down. And at this point, I was thinking to myself, you know what? They might come back up again. And then we have a very nice head and shoulders pattern. So there's your first shoulder. And this one was your move. Whoops, get that one out of the way. And then this one was your move back down to the other shoulder. And here we retested the shoulder again. So at this point here, I was thinking to myself, it looks like they're building a base. And you can see that if I push this line here and put that on the shoulder's actually there. And that's where I was looking for an entry around that point there. Now, you can see we've got these wicks are slightly yellow, not brilliant, but it was late on Friday. So I was looking for a trade around this level. So me being me, I went down onto the 1-minute chart and I looked for an entry. So that's our trade area here. That's where we're looking to get in. And what you can see here, we've got the formation of color candles, high levels on the histogram. So I just go in at those levels because it's already proved itself here Here you can see it's tested, here you can see it's tested, and you can see all the way along you've got this level here, you've got these levels, and you can see every time it backs into those levels on the histogram. Let's see this one here. You get peaks in the histogram. So let's just bring that up there. So when I saw the purple bars at that point, I just go long, and my target, because it was Friday night, was the previous top. And that's what I was doing. So here we came down again, slightly above the level, but you can see we've got a massive reading on the histogram. As soon as I see the blue and aqua candle, I don't try and get clever. I just jump in when I see the market starting to move in my direction, and I hit that previous top. Now, if you'd done that sort of trading late on a Friday night, you would have got in here, you would have had about 76 points there, and you would have got in about there. You would have had another 60 points there. And that's pretty much what I did. So those two trades were pretty good. I didn't catch the big fall. You know, I was looking at it and I didn't see it. So sometimes you can miss these big trades like that one. It happens, you know, Friday, sometimes I'm not with it. Days of the week you should trade. Avoid Monday because the market's figuring out a direction. Trade Tuesday, Wednesday, and Thursday, and really don't trade Friday because Friday is profit taking day. And very often the market will make a move in the opposite direction to the way you think. Because this market was moving up. You can see on Thursday we had a very strong Thursday. And that's why I think I got the direction wrong on Thursday, because I was not anticipating a move up. I thought that we had on the 7th, I thought I had my top and my bias was to the downside. But if I had looked on the 7th, I wouldn't have seen any liquidity voids forming. And that's the first warning that you're not going down, is you don't get the formation of liquidity voids, because voids only form when you have a lot of money in the market, and that's why they form. Okay, so over to you guys. Any questions? Yeah, lovely. Good. So both of you two, the two people in my group, I know both of you guys, and Paul, we've traded together. Right, can we draw a line and look left? We certainly can. What time frame, Paul? Okay, let's do that. So go to the 4 hour. I'll just clean up this chart. In fact, I'll just draw a completely clean chart. I know what you're thinking. I was thinking the same thing. Are we at a level? And you know, straight away, the eyeball is drawn to that level there. We've got an order block here. And this, we've got a liquidity void up here. You've got a massive void there as well. So that level was interesting for sure. Absolutely interesting. I agree with you, Paul. That's that's a level. We tipped it, and then just to take, now they took liquidity. That's really interesting because here's this little kind of doji set up on the 4 hour, and then what they do is they slam into it and they just take out the liquidity at the top. So that's a grab there. So it's going to be very interesting what happens on Monday. But don't forget, you've also got your stock market cycle. So in a bull market, Monday and Tuesday are usually strong. Wednesday, sometimes Thursday, you get a counter trend pullback. And then Thursday and Friday are usually strong into the close on Friday. Now, what we didn't do on this Friday is it wasn't weak, but it wasn't a strong move either because we sold off. So it's going to be interesting. The thing is, I have this cycle on the 17th of or 18th. So we've got to be careful because I don't know exactly where that cycle is going to land. So caution is advised in this area if the cycle works, but if it's a day early. So if we watch price really carefully here and we look for it to take out the previous swings, I think that we will actually see the market declare its hand, and we will know if that cycle is in, because we simply take out that low. And the great thing about that is once we take out that low, the probability is that we go back up again. And then here you can see that we've got, although this is an hour chart, I like to see the voids on the higher time frame. If I put that in, we have a liquidity void, which was down to there, but now has been traded into. So in effect, that void, yeah, they just took the void out just there. So that was quite interesting. Be interesting to see actually if this market actually falls on Monday, gaps down, or whether it gaps up. If it gaps up, it's an amateur gap, and an amateur gap is very often found at the top. And if we go back to the previous move where they put the top in, you can see that they traded it down to the Asian session range here. And this was obviously a Monday because it gapped up. So they gapped up to stop all the traders out. Not that they want to stop them out, it's just that there was a load of liquidity up here. And then they sold off. So this is what you call an amateur gap. I just put an A in there. Amateur gaps, they're not filled and respected. Professional gaps are, but amateur gaps are just traded all the way through. So there would have been people who would have been thinking, oh, that gap's going to get filled and then the market's going to continue in the upward direction. But an amateur gap forms at the end of a long move, and it basically is the gap that you expect not to be filled. In fact, it's a warning sign that the market is overextended and likely to reverse. So that's a cool one. I might do a video on that. Okay. Yeah, I don't think we should predict, Mark. I think what we should do is we should wait for the market to flip its hand to us, because as soon as we see what it's going to do, we just have to react. We don't have to guess it. And I think that once we get the formation of a liquidity void, once we get that 900-point fall, and then the retrace back up, all we have to do is we just have to, just look for where the liquidity voids are. Look where the aqua candles are forming in that liquidity void, and then we can just nail it. Interesting thing, I show you guys this is something that I got into when I was doing analysis on the markets using Fibonacci. The first wave sometimes gave the termination point of the whole of the move down. So if you measure the first wave like this, sometimes what you will find is that the big wave stops at 1.618, 2.618, or even 3.618. And the interesting thing is when this market moved down, I'm not sure if you guys can see that, but it stopped at the 3.618 level pretty much perfectly. So when we do, if we do come, and if I copy this here, and if we assume that we get a similar first move down, then where could that market go? And I know, Mark, I say I don't like predicting, but I love it. So we've got a couple of good choices for where this market might fall to. We've got there, which is 3.618, and we've got the 2.618 there. So that's a good target. If we come all the way back up, we bounce up to here and we come down and we just hit that, that's 2,000 points. That's 3,200 points. And the great thing is this move is not likely to just fall straight. It should swing like this. So once we've got the message from the market that we're going down, we will try to establish a position here, another position here, and another position here. So that's 3 positions that you'd like to put into this market, and usually that's about the limit. So if we get a similar fall on the S&P, we know, because we can anticipate, that we've got the move there, which would be about a 3,300 point fall. We've got this move that would be something like that. So I'm just going to put that one in and we'll just see how many points it is. This one is 3,000 points, and then you'd have a move something like that. So you should be able to accumulate probably 3 positions, even at say $1 a point. They should all hit a target of around 3,280 to 3,000, 2,800 to 3,000 rather, and you've got 3 positions, so that 3, 6, 9. So even with a small account, you should be able to make about 9 grand on that drop, even if you were just trading for say euro a point, a pound a point. And that's how you make really big money in these markets, is that you get in 2 or 3 positions and then let that run, and hopefully we'll be able to predict this market down here. And the other thing that I'd look at, although I don't put much countenance with this, is if we did just a simple ABC move and we just copy that move and we just see where that would project to. And I'm not saying that we drop from here, but if we do drop from here, then that would be a good projection target, and it kind of agrees with the 3.618 level. So I think that would be a highly probable target if we do start to break down. The thing is that the time frame that you're looking at for a breakdown is quite a long time frame. You're not looking for the swing to happen overnight. If we look at that one, this 4-hour bars, you see that's 82 bars. Sorry, that's the hour chart. Yeah, this is 82 bars from here. So even if we get a pull down and it breaks that low, we should expect a similar sort of swing. I mean, if we just have a little look and we just copy that swing, just looking at time swings, you can see it's not so different to that one. Doesn't hit all of them, but you'll find that it's not so bad. So there's a little symmetry in time that's going on in this market. So what would I do? I'd simply do that, and I'd say, okay, if this market does fall, where would I be looking for it to pull back up? And there you go. Okay. Did I also inspect the BTC chart? Hello, Thomas. Yeah. And thanks, Mark, for your comment. I love that. Did I inspect the BTC chart? Yeah, let's go and have a look at BTC. I know because Thomas loves it, and it's a very cool market to trade. So I'm just going to bring up my BTC chart and we can have a look at that. Okay, so let's make this clean. I've got a cycle analyzer on this chart at the moment, and what it does is it synthesizes the waves that it finds. It finds the waves here using a Gerstl's algorithm, and then it weights them according to a Bartel's test, which is a probability test, how long the wave stays in the data. But the problem is that the time frame in Bitcoin is not linear. They take an hour out and put an hour back in. So the analysis of this can't be massively accurate because the time frame keeps contracting, and so it ruins the cycle algorithm. However, in absence of everything else, this is all we've got. So I'll explain what I'm looking for on Bitcoin. So the first thing you've got to do, I mean, we don't need the cycle analyzer, first of all, but what you have to do, and this is really important, is you have to look at where did the power come into this market? Power, what do I mean by that? And even before we put the indicators on, you can see straight away that that's a power point. Why? Well, what do we have going on here? We've got this little black candle, which is who's active there? Well, that must be small time traders. Why? It didn't move very much. Big guys don't move the market like that. Big guys move the market like this. So what that says to me straight away is that small little black candle before the big push up says buying pressure. So I simply mark that like that. So that's a really key level for me in Bitcoin. And that's on the 4-hour chart, Thomas. I know you don't like that one, but that's where you do the analysis, because that will give you these massive swings. And the other black candle I'm looking at is this black one, and I'll explain why. I'm looking at that black one because it was the last down candle before the push to the upside. And okay, it didn't do it in a single bound, but it did quite a steady little move up away from it. Now, I didn't mark that one because there's no power. You know, when you mark this one, within one candle, bang, it's just moved out of that zone. This one, it was just trading sideways until it got to here, and then it went up. Now, very simple thing you can do in terms of where are we going? Well, let's do a little bit of an analysis. And we've got this level and we've got this level. We don't know which one it is, but the histogram will give us the heads up. A couple of levels that I like to look at are the 78.6 level, which is this level here, and the 70.7 level, which is that one there. So I would mark this level. This level I wouldn't really worry about. Fibonacci doesn't mean very much. It's just to kind of eyeball where could the level be. I'd mark the 88.6 and at the very last one, 94.1. And that's as far as I'd go with Fibonacci. So I'd have those levels marked. I really would want it to see Bitcoin tag into that level. And I'm going to give you that level, Thomas, because I know that you're going to slap that on your chart. And there. So about 59,166. I would look left and see, do we have any other levels here? Because although this is, I'll just take the cycle indicator off a second. Indicator list, we'll take that off. I'd also look at this chart from a pattern perspective. You know, it could be that you've got your shoulder occurring here. So let's just make this nice and big. So you've got a shoulder occurring there. You've got this little push up. So this is not a head and shoulders pattern that people like, because this neck didn't break this neck. But I've seen this time and time again. It doesn't have to. It sometimes will, simply break something like that. And so then we have a upside down head and shoulders. So I'm going to go across from this level here, and you can see that this is kind of giving us confluence in this very level where we've got this little black candle, which is the real kicker for moving this market up. And you can see we've got all sorts of other bits of information, the way it spiked up here and then got sold off. So there were people here trying to sell this market. You can see on that wick there, it came up, got hit down hard, and then I'll take that off. You can see these little wicks where sellers are trying to get in. They've seen this downtrend and they're going with it, but the market makers are saying, no, you sellers, we're going to wipe you out. We're going to push it up. So this is going to be a key level for Bitcoin. And this is where I would put on my histogram, put on my liquidity voids, and I look for my first 15-minute aqua candle in this level. Thomas, very important. You look at the levels, mate. The levels are the key to this. The aqua candles are good for telling you where liquidity is, but the levels are really what you should be drawing on your chart. So that's it. That's it on Bitcoin. I do nothing until we come into my little blue box, and then I'll get busy looking for the correct signal. So let me see. Did you get that, Thomas? Why do I use those levels on the fib? 78.6, 70.7, these are a typical level for a retracement. So that's where you're looking to buy. Excellent. So I just put those fibs on the chart again for you because I used to just use fibs exclusively, and that's just a waste of time. The thing is, the market's reacting around those levels, not because of Fibonacci. The market's reacting around those levels quite simply because there's orders, and that's what the liquidity will actually tell you. So I'm just going to put on the liquidity indicator. Of the millions of indicators that I've gone through in the years, I've still got half of them on my chart, and they're useless. These are the only ones I actually use at the moment. So let's give that a nice little bright look there. So this is great information because it tells you when Bitcoin came down into this level, where was your liquidity forming? Well, it was forming there. So when you look at the liquidity here, what's it telling you? It's telling you I'm not ready to go up yet because the liquidity is too low. And I had this with Paul on one day. He said, "Oh, it looks like the market is turning," and it did. And if I didn't have these indicators, I would have probably jumped in with him. But because I had these indicators, I said, "No, liquidity is too low." So if we look at the top of Bitcoin just there, we've also got at the top that level of liquidity. So I'm going to widen my liquidity zone like that. And that tells me that I have to pay attention to Bitcoin when liquidity hops into this area and when I start to get aqua colored candles. The rest of the time, I'm doing nothing. I don't want to trade it. I don't want to be the one guy fighting that market. I want to be the guy who is actually jumping in there when the market makers are going, yeah, we're going to spin these retail traders around. We're going to take their orders. That's the side I want to be on. So I'm looking for the market makers to give me the heads up that they're getting involved in this market. And that's why liquidity is so important, Thomas. We have to take that into account. You got it? Excellent stuff. I'm so glad. You guys are excellent. I really love it. Well, I've been at this now 48 minutes, so I'm taking questions and having a sip of my coffee. If you can hear slurping, don't worry, that's me. Come on, someone's got a question. Okay, Paul, fire away. Sorry about my slurping in the background, but this is my second cup of coffee today and I'm savoring it. Okay, and Paul's question is coming through, so I'm just waiting for that. I don't know why it doesn't come through faster. So I get this, but it's really the time frames I struggle with. Okay, what you mean like this, Mark? uh, okay, thanks. So you struggle with the time frames. What about the time frames do you struggle with? Is it that you struggle with drawing levels on the time frames, or you struggle with which time frame to use, or which time frame to enter? What's the thing that you're struggling with? Because I think I can answer your question. I don't know. There must be a delay on this feed because I'm sure Mark, I'm sure Paul types an awful lot faster than these messages appear. So have a little bit of a stretch. Oh, before Paul's message comes through. Okay, so here on the 4-hour makes sense. How do we bring that down? Okay, I get you. So the first thing you want to do is do your analysis for your levels on a 4-hour time frame or an hourly time frame, absolutely minimum. So let's take this chart from scratch and I'll run through it. Okay, so excuse me, I'm going to go onto a blank chart, and the first thing I would do to mark any chart up is I'll put it on closing price. Why? I think closing price is pretty powerful, and all I'm going to do is I would mark the highs, closing highs, like this. And for the 4-hour time frame, you know, stuff like that, stuff like this, we're looking for areas where the market's bounced, and you can see that we have this area here on the larger time frame. So there's your head and shoulders pattern, although it doesn't look great because it's an asymmetric head. That's fine. Sorry, asymmetric. This shoulder usually would need to go above here, and that would be kind of confirmed pattern. But it didn't confirm, and these are usually the ones that work because most traders think that's a continuation of the downtrend. So these levels are on the 4-hour, and you can see at that 4-hour low what an incredible head and shoulders pattern that was there. So if you'd been busy marking your levels, you would have definitely marked that little swing like that. That's a pretty powerful level. So even though the swings are small, they can still be pretty powerful. And also on the closing price, we can see some quite nice things. We got 1, 2, 3, 4, 5. So this looks like a 5-wave move to the downside. And usually 5-wave moves can be the termination of a trend sometimes. But, you know, we could get a head and shoulders pattern formation here, i.e. we push down a little bit more, come back up, make another little shoulder. So we'd have something like this, and then we'd bounce back up that level, and then we'd come back down, something like that, and then we might have the opportunity to take a long trade. So the first thing is always start off on a 4-hour chart and mark your levels like that, because these are going to be the major levels. This is where the big boys are trading in the market. So it doesn't matter if I leave those levels on. If I want to trade on a 1-minute chart, those levels are still going to be very, very important to me because they're on a higher time frame. So higher time frames are important because if you look at this move here, you've got all the little squiggles there, but on a 5-minute time frame, there would be hundreds of little turns. So the big time frames, you think that you're getting in late, but the big time frames are where the big moves start, and I want to catch the big moves. I'm not, although I can scalp, it's stressful. You're in and out, you're in and out. I'd rather trade a big move, and hence that's why the closing price levels on the H4 chart are sort of where I begin my analysis. And you don't have to, you know, there's no right and wrong. That's a level there. You know, it comes, bounces off it, breaks down through it. From the downside, once support is broken, it becomes resistance. So also when we start to trade above there, the market's telling you, hey, maybe I'm not going down anymore. So you have to pay close attention to these levels because they're telling you a lot of good things. And if we go on to the chart, you can see we're slapping into this level here, but we're not down to the wick levels. So it's fighting this level, but it's not bouncing up and it's not going above there. So I think we still might have some more to the downside. Does that help, Paul? Excellent. So the larger time frames, the bigger the moves. So we could, and I'm going to do this now. I don't think we're bounced from here, but we could actually go down to a 5-minute time frame, and we just want to see the interaction at these levels. So there, those are your levels. So how would I'll even go down to the 1-minute time frame because I think it's important that you guys understand that you can trade a 1-minute time frame provided you're at a level. So what would I want to see? Let's say we came down and touched that level. Well, I would want to see liquidity. I'd want to see the histogram rising. But if I didn't have those indicators, I'd want to see a push to the upside. I want to see a push to the downside. I think some of you be familiar with this. And then I want to see a break of that little swing top. So if I transfer that onto a chart now, that's the first push. That's this one here. I don't know what's going to happen because we haven't had the push to the downside. That's still in formation. But if that level was going to hold and we get a push like that, that's my trigger. Once we break that high, I'm looking for a pullback to this level again. And at that level, I'd be looking to take a long trade. Now, this market hasn't confirmed yet, and it's also Saturday, not a great day for trading Bitcoin because the liquidity is not there. But if you come to a level and you use this rule, even on a minute chart, you're not getting in at the low. That's difficult. I know. I tried that for 5 years. You don't want to try that. Waiting for that first push at a significant level is going to give you a massive advantage because it's telling you that this market is going up because you're breaking on your smaller time frames. You're breaking those little tiny 1-minute waves, but those 1-minute waves are the first indication when you're at a turn that the market is actually going to turn. Because if that was a big turn there, all the waves would sync up. You know, your 5-minute wave low, your 1-minute wave low, your hourly low, your 4-hourly low would all sync up in the same position. And that's why when you're at a level, you can use this sort of price action because you're at the level. It's not magic. You'll get this sort of formation happen everywhere, and it doesn't mean anything. But when you're at a level, that's when the breaking of that previous high, the retest, will get you into these markets with really, really small stops. Because usually, if you're right, it won't even trade back in this area again. Does that make sense? I'm going to have to do a video on this one because this sort of entry method is quite cool. Would I use the 1-hour levels or the 4-hour? I'd use both, Paul. You can combine any time frame you want as long as you're using one larger time frame that's about 3 times time frame that you want to trade on. So if I was trading a minute chart, you could in theory use a 5-minute chart. It's 5 times as big. However, I like to trade on the 4-hour or the 1-hour for levels, and that's it. Okay, Mark said levels usually trade to the next same time frame level. What can I say? Genius, mate. Absolutely correct. Absolutely correct. So, any more questions? And got a question for you guys. What would you like to see a video on? As I sip more coffee. Anyone? Fibonacci retracements? Thank you. I'll do that, Mark. Hold on. You've been watching too much Beheza. In depth on the indicator. Okay. ASMR, Asian support and resistance. I don't know what that is, Mark. I might have to have you up here to do that because you're excellent at that. I'm going to have to read up about that. But I'll do an in-depth on the indicators. Okay, let's do that now because this will be fun. Okay, so in-depth on the indicators. Right, so what I'm going to do is use the template that I've got called SuperTrader, and that puts on the histogram and the map. And also we've got another cool indicator, which is the liquidity estimation on the higher time frame. You don't necessarily need this, but what it does is it really focuses your idea on where you should be looking. But you can figure it out for yourself. Here, for instance, you can see the aqua blue candles. Straight away, I would say to myself, in this area, we have liquidity. So I would simply draw a block on those aqua blue candles like that. So that, for me, would be higher time frame liquidity. So you can see the higher time frame liquidity indicator is telling you, guys, look, this is where liquidity is. So if I was too, if I didn't want to be bothered, let's say, I wouldn't have to, because this indicator would actually be showing me where liquidity is. And you can see up here, we've got liquidity, but we've got these dark blue candles as well. So if I put that on there, that's telling me I can see those dark blue candles. I don't need an indicator to tell me that. But if you do want an indicator, then the higher time frame synthetic liquidity is excellent. Of course it is, because it means I don't have to think. I don't like thinking. It hurts my brain. So that, for me, tells me if I want to start trading that market, I should be looking to trade either this low or either this area high here. So that's it. You know, it's as easy as that when you are looking at where the liquidity is. But if you want to mark this liquidity yourself, well, look, you've got these aqua blue candles at a turn. And if we come across from here, and I just mark that like that, where's liquidity? You can see it, the indicator saying, look, liquidity, market didn't quite make it to there, but it's telling you liquidity is up at that level. It's very, very, the indicator you have, the map, is absolutely brilliant at telling you where liquidity might be. You can use the higher time frame synthetic liquidity indicator if you want, but for me, you don't necessarily need it because you've got all the information on the other indicators anyway. And I'm not trying to belittle it because it's a piece of genius. You can see as this starts to turn over, it's telling you, I wouldn't have seen that liquidity up there. I wouldn't have seen this liquidity building down here. But if you just put the liquidity map candles on, you would definitely see them because the map is already telling you where liquidity is. So a lot of people say, oh, yeah, Mike, I've got to have that indicator. You have, but you don't necessarily need it. I mean, I can see here that we've got liquidity here. We've got liquidity here. So I can draw a little box and I've just estimated, hold on, shapes. I've just estimated where liquidity is up there. You can see the color candles. You can see that it was a swing. You can see the histogram is high. So I know that just using the map candles, I know where liquidity is. It's up here. And you can see, I don't know if you can see, it might not come up, but just here, we've got this dotted line and the indicator saying to me there might be liquidity up here. I know it's up there. I can see it. I've got these candles to tell me that that's where liquidity is. So the map is not just for telling you where liquidity is forming now. The map also tells you where was liquidity in the past. And the market is only trading from one area of liquidity to another area of liquidity. Okay, I'm going to have to look at the comments because I rattle on for too long. Okay. Okay, right. So it saves time, Mark. That's exactly what it does. It saves time. It saves thinking. The computer just does a calculation and I can just sit back and just take it easy. So if you're on a 15-minute chart, what about it, Paul? And yes, Mark, you're absolutely right. You can choose what you use. I mean, your brain is so much more sophisticated than our algorithm. You know, you can figure this out. All the information is on the chart for you. The map is telling you where liquidity is. So what's Paul's question? So Paul, you say if you're on the 15-minute chart, I need a bit more than that. If you're on the 15-minute chart, what about it? Yeah, absolutely. So if you're on the 15-minute time frame, the higher time frame is telling you, yeah, let's go on to a 15-minute high time frame on Bitcoin, and let's see what's going on. And you can see that actually liquidity is it's flat. So I know some of you trade Bitcoin at the weekend. Would I trade Bitcoin at the weekend? The answer is no. Why? Liquidity is nothing. So why would I want to trade in a market that's not going to move much? You know, the probability of this market going up is probably 50%. The probability of it going down is 50%. So if I take a trade when liquidity is low, I've got a 50-50 chance. That doesn't really help me. You know, I want a higher probability. I want a 70-80% probability that something is going to happen in my direction, because then I have an edge. When you're in a flat market with no liquidity, you've got no edge. And this is where, you know, you could put something like the algorithm here, and it would just go long and short and long and short, because in a directionless market, just as you think, that's going up, and you buy, it turns and it goes down. So it's not fun to trade. And also the reward that you get for sitting in front of your chart is tiny because it's not going anywhere. So you think to yourself, it's not going anywhere. I know what I do. I use really big positions. And then suddenly it makes a dramatic move for some unknown reason, and you wipe out your account. Now, if I said I was talking from experience, I wouldn't be lying. And this is why I don't trade currencies, because currencies tend to sit in ranges like this and then make a dramatic move in one direction or another. And suddenly your account's gone because it wasn't moving. You suddenly decide to up your lot size to £10 a point or £20 a point. And then suddenly you get, for some unbeknown reason, you get some massive move in one direction or another, and you've just lost $2,000 in the blink of an eye. So this is why in trading, you've got to be disciplined. You've got to say to yourself, when do I make my money? You know, if you're running your business and you set up at 12 o'clock at night, you open your front door and you say, yeah, I'm going to get loads of customers. Well, you're not, because there's no one on the street. So the market is exactly the same thing. You should be trading when there's plenty of people there, because you're going to get volatility, and volatility is liquidity, and that's what's going to make you money. So I know, Thomas, you trade over the weekend, and I know it's because you have to, but it's the riskiest time to trade, and your probability drops to 50-50. So why do that to yourself? It's just creates a hard life. Okay. The problem is when the synthetic liquidity is repainting. Yeah, sure, it does repaint. So we still need the histogram. Absolutely right, Golden Chick. It does repaint, but it's only an estimation. It's a bit like me looking out my window and I go, it's cloudy, it's raining. I think it's going to be bad weather today, so I'm going to take my umbrella. Now, I could get out the door and 5 minutes later, the weather changes and I don't need my umbrella. So it's called synthetic liquidity because it is synthetic. It's not actual. It's kind of where could it be? So that's why you can't just use it on its own. You've got to draw your levels as well. And if you draw your levels and the synthetic liquidity indicator is printing, and you get aqua and blue candles, and you get a high reading on the histogram, well, you can't do more than that. Yeah, Mark, you're right. It's a best estimate based on the current input of the market. And that's all we can do. We can't predict liquidity. It's impossible. All we can do is stay in the moment and do our best to estimate where it's forming, if that makes sense. You know, Mark, we've got Anne chained up in the basement and she's just writing code. And that's all she does. We don't let her out until she finishes it. And she does a spectacular job. I mean, we're working on some other ideas as well. One is a timing tool. Another one is where are the banks trading coffee? I think we have to keep her awake. No, what we're doing is we're trying to make the best tools for you guys because we want the best tools to trade as well. The thing is, these tools were developed because of Anne's love of the market, my input into what was going on. But the reason that we developed these tools is because they actually work. You know, Mr. Casino started his group where he talks about FU candles and all the rest of it. And I had a look at some of his stuff. I can't understand it. Thomas, we can reactivate your account. That's not a problem. Talk to me later, and we get that done for you. Yeah, Anne is exceptionally talented, and she's a delight to work with. And together, we want to create the best tools because I actually trade myself. So if Anne makes something that doesn't work, I don't get any success out of it either. So listen, guys, I really trade. And I think Paul knew that when we were sitting having the session together. We had a really good day on the Wednesday, and I actually use these tools as well. It's what I do to actually make money, is actually trade the market. And if you do it right, Christ, you can make a lot of money. But if you are doing it wrong, thanks, Paul, you'll lose a packet. And this is why, you know, Thomas, I snapped at you the other day because you have to have a methodology. You have to have a routine. It's just like flying a plane. You can't get up in your plane and say, oh, what does that big stick in the middle do? I know, I just push it all the way forward. You go straight into the ground. So you've got to have a structure, and you've got to have a structure in your trading. The first thing is 4-hour chart. Put it on close price. Smoked account. I did many smoked accounts, Mark, and it's how you. So the first stage is 4-hour chart on the close. Mark levels, guys. It's so easy. You know, my cat could do it. Please show us a sniper tool as well. Okay. I don't know if I should do that, Golden Chick. Maybe we do that on a one-to-one, or I've been at this now just over an hour. So I have to say, we can do another session next weekend because now I know how to do this. So we do that next weekend, another session showing the sniper, how it works. I'm not trying to sell anything to anyone here. This was just a questions and answers. Okay, so next session, guys. I've loved it. You have been a fabulous bunch. And you know me, you can ask me any questions anytime you want. And I'll always do my best to help you. Thomas, I'll sort out your license for you. And Golden Chick, next weekend, we do a session on the sniper. And this, Paul was using it over the weekend. No, he was using it on Friday on gold. And he was like, wow, this thing just makes a lot of money. I'm sitting here and I'm just using the sniper. It's the algo. I'm just letting it trade, but I'm telling it what to do. So I say, yeah, buy, sell, and it just does its little trades. It is addictive, Paul. You're absolutely right. It's the crack cocaine of trading. Okay, guys, I really enjoyed this session, and we're going to do another one next week. Golden Chick, I won't forget you. And Thomas, I'll get everything sorted out for you, mate. All right. Well, listen, guys, have a great weekend, and I will be about on Monday. Take care, guys.